The IRS just released their final regulations for non-spouse beneficiaries of retirement accounts, clarifying a question we've had for a number of years, which is, are non-spouse beneficiaries that are subject to this new 10-year rule also required to take annual RMDs, or requirement of distributions, from the account each year in addition to the 10-year rule? So back in 2019, the IRS passed what's called the Secure Act, which changed the rules for non-spouse beneficiaries of retirement accounts, making most of them subject to what's this new 10-year rule, which means a non-spouse beneficiary, after they inherit an account, have to deplete that balance within a 10-year period. But when the regulations first came out, it was assumed that, okay, they got to deplete it in 10 years, but they're not required to take any amount out if they don't want to during that 10-year period. Then the IRS came out and said, whoa, wait a second, that's not necessarily what we meant. And we've been in this whole proposed regulation limbo for the last few years, waiting for them to give guidance as to what non-spouse beneficiaries were supposed to do. Instead of offering a definitive yes or no, they actually came out and said, well, it depends. It depends on a number of items whether or not a non-spouse beneficiary is subject to this new RMD rule. So some of the stuff we're going to cover in today's video is what the new RMD requirement is for non-spouse beneficiaries. When are these RMDs set to begin? Will the IRS be assessing any type of penalty for missed RMDs? Are these non-spouse beneficiaries going to have to make up for the missed RMDs for the last few years? There are different rules for RMDs, whether you have an inherited traditional IRA or a Roth IRA. They also created different Roth rules, whether it's a Roth 401k or a Roth IRA that you inherit. And we're also going to go over some common RMD mistakes for the stretch rule beneficiaries. But instead of just focusing just on this new RMD ruling, I am going to take a step back and explain how these non-spouse beneficiary inherited IRAs work in general. I'm also going to go over the rules depending on whether the decedent passed either before or after 2019, which matters, the new 10-year rule that most non-spouse beneficiaries are subject to, when beneficiaries are granted an exception to the 10-year rule, how these required minimum distributions are calculated, the taxes you pay on distributions from an inherited IRA, and some of the tax strategies and pitfalls associated with inherited IRA accounts, as well as a quick special rules for minor children that inherit IRA accounts. When you are a beneficiary of a retirement account, whether it's an IRA, 401k, or other type of retirement account, you fall in one of two baskets. Either you're a spousal beneficiary or you're a non-spouse beneficiary. Now, in this video, we're going to be focusing more on the non-spouse beneficiaries. Now, if someone passed away prior to January 1st, 2020, you are grandfathered in under the old rules as a non-spouse beneficiary. So nothing's going to change for you. So if you inherited one of these accounts, someone passed away before 2020, nothing's going to change. You are still eligible for what's called the stretch provision. So under the old rules, a non-spouse beneficiary inherited a retirement account, rolled it over to an inherited IRA in their name, and the IRS said, look, you just have to take small requirement distributions each year, but you don't have to deplete the account in any specific time frame. Just a quick note of clarification, those RMDs are required minimum distributions were the minimum that a beneficiary had to take out each year. You could always take more. I mean, all the distributions, if it's coming from a pre-tax retirement account or IRA, is going to generate taxable income for the beneficiary. But if it's coming from an inherited account, there's no 10% early withdrawal penalty, regardless of the age of the beneficiary. This all changed in 2019 when the IRS passed Secure Act 1.0, when they said, hey, instead of allowing these non-spouse beneficiaries to maintain that inherited retirement account for the rest of their life and just take small RMDs, they replaced that stretch rule, which what's called the 10-year rule, which now requires non-spouse beneficiaries that inherit these retirement accounts to deplete those retirement accounts within a 10-year period, and that 10-year period starts the year after the decedent passes away. As always with any new tax law, there are exceptions to this new rule. So instead of saying, hey, anyone that passes away after December 31st, 2019, all non-spouse beneficiaries are subject to the 10-year rule. They carved out a few non-spouse beneficiaries that are allowed to still access the stretch provision. And the beneficiaries on an exception list are the surviving spouse, any person less than 10 years younger than the decedent, a minor child, a disabled person, a chronically ill person, and some see-through trust benefiting someone on this exception list. When we consult with clients, the most common exception that we run into on this list outside of the surviving spouse is a beneficiary that's not more than 10 years younger than the decedent. This is common with siblings, or you inherit a retirement account from a cousin, and if you're not more than 10 years younger than them, you no longer are subject to that 10-year rule where you have to deplete that account in 10 years. You are now grandfathered in under the old stretch rules, which says you can move it to an inherited IRA and just take small RMDs over your lifetime. The other exception we unfortunately sometimes see is the minor child rule, where a minor child is the beneficiary of a retirement account, and there's a mix of rules. So we're going to create a separate article video just on this topic, but high level, if a minor child inherits a retirement account, if it came from their parents, there's one set of rules. If it came from a non-parent, there's another set of rules. So if it came from a parent, it's a blend of the two. So they allow the child to take the money, put it in an inherited account in their name, take small RMDs until they reach the age of 21. Now, they use the age of majority, but the age of majority can vary from state to state. The IRS came out and clarified that it's age 21. Once they reach age 21, then they automatically transition over the 10-year rule that requires them to deplete that inherited retirement account 10 years after they turn 21. If instead they inherit that account from a non-parent, the child is immediately subject to the 10-year rule and has to deplete that account over that 10-year period. If the non-spouse beneficiary inherits a retirement account from someone who passed away after December 31st, 2019, they are subject to the 10-year rule unless they qualify for one of those exceptions. The 10-year rule is not different whether you inherit a traditional IRA or Roth IRA. Those are subject to the same 10-year distribution restriction. However, as we're going to cover a little bit later on, the RMD requirements may be different. When the IRS just released their new RMD rule for non-spouse beneficiaries, they basically come out and said it's going to matter based on what the age of the decedent was when they passed away and whether that account you are inheriting is a traditional IRA or a Roth IRA. Here's why the age of the decedent matters. They basically said in the regulations, if that decedent had already reached their required beginning date for RMDs, meaning they had already reached that age that required them to take required minimum distributions from their own retirement account, if they triggered that date, then when the non-spouse beneficiary received their IRA account, not only were they required to deplete that account in 10 years, but since RMDs had already begun, they can't stop. So then that non-spouse beneficiary is required to take RMDs each year during that 10-year period. However, if the decedent passed away prior to reaching the start date for their RMDs, then the non-spouse beneficiary inherits the account and they're subject to the 10-year rule, but not required to take required minimum distributions each year from that inherited IRA. If you're trying to figure out whether that decedent was at their RMD start age or not, here's a little table that shows, based on the decedent's date of birth, if they were born 1950 or earlier, the age was 72. If they were born 1951 to 1959, their start age for RMDs was 73. And if they were born 1960 or later, the start age for RMDs was 75. Let me put all this together for you in an example. So let's say Brad's father passed away this year in 2024, and he is the sole beneficiary of his account. So Brad's a non-spouse beneficiary, and let's say his dad was 80 when he passed away. So his father was already beyond the required beginning date for RMDs. He was already taking small RMDs every year from his own retirement account. When Brad inherits it, he, as a non-spouse beneficiary, is now subject to that 10-year rule, meaning 10 years starting the year after his father passes away. that account has to be depleted. Brad could take a tenth each year. He could take more on the end, less on the front end. But because his father had started taking RMDs from his account, Brad would at least be required to take requirement distributions from his inherited IRA each year throughout that 10-year period. If we keep everything in that first example the same, but the only thing we change is the age of Brad's father when he passed away, saying now Brad's father passes away when he's 68. So he hasn't reached the required beginning date for his RMDs. Then when Brad is a non-spouse beneficiary, inherits his father's IRA, he's subject to the 10-year rule, but now he's no longer required to take requirement minimum distributions each year from that IRA because his father hadn't reached his required beginning date. For all these non-spouse beneficiaries that are just finding out that they got to take these annual RMDs from their accounts, the question becomes, when do they have to start? Do they just issued the regs in 2024? Do they have to start in 2024? Is it 2025? Thankfully, the IRS has been issuing guidance throughout, and they said, hey, you don't have to do anything in 2024. You don't have to do anything for the RMDs that you missed. Let's say you inherited a IRA back in 2021. So there was 21, 22, 23, 24. Technically, RMDs should have been coming out of that account if they go by the new rules. But the IRS has said, hey, listen, we weren't clear. We hadn't clarified the rules yet. So all RMDs for these inherited IRAs are going to be required to start in 2025. But these non-spouse beneficiaries don't have to worry about going back and making up for those missed RMDs. It's going to operate as if everything's been operating smoothly starting 2025. However, even though they're giving this blanket waiver for RMDs while they clarify the rules, it does not reset the 10-year rule that these non-spouse beneficiaries have. So again, I inherited a retirement account from someone that passed away in 2020. My 10-year period technically began in 2021, so I would have until 2030 to fully deplete that account balance. That has not changed. Just because I haven't taken RMDs, they don't bump me out another 10 years now. My depletion date is still 2030 for that inherited IRA account. We've been talking about all these exceptions because the IRS is essentially playing catch up with all these rules. But let's say someone's watching this in 25, 26 and all the rules are enacted. The way RMDs work going forward is someone passes away, let's say this year in 2024. Your 10-year requirement doesn't start until the year after. The first annual RMD that you have to take out of the account typically does not start until the year after that person passes away. There's a reason why I say typically with the RMDs beginning the year after the person passes away, because there's a whole separate set of rules about the RMDs for the decedent. So if the decedent had an RMD requirement in the year they passed away and they didn't fulfill that RMD, let's say they were supposed to take $20,000 out and they passed away before they could do it, the beneficiary of that IRA is supposed to take what the decedent would have had to have taken by 12/31 of the year they passed away. So in those instances, you got to answer the question, did the decedent satisfy their RMD requirement? If yes, nothing you have to do. If they didn't satisfy the full RMD requirement, then the beneficiary has to know, I got to take that remaining RMD amount before 12/31 of the year the decedent passes. This is where the road begins to split between Roth IRAs and traditional IRAs. Because if you own a Roth IRA, there is no RMD requirement. Even if you are the original owner, it doesn't work like traditional IRAs and pre-tax 401k accounts where you hit that age and you got to start taking RMDs. Well, since Roth IRAs never technically have an RMD start date, if you inherit a Roth IRA and you are subject to this 10-year rule, by default, you do not have to take RMDs during that 10-year period. You just have to make sure that Roth IRA is depleted by that 10th year. The IRS made a very strange rule when it came to Roth 401k. So we were just talking about Roth IRAs, but within the 401k world, you can have both pre-tax deferrals, Roth deferrals, employer contributions, all mixed into these 401k accounts. And I would have guessed that, okay, if you had both Roth and pre-tax in a 401k, someone inherits it, okay, the pre-tax stuff, 10-year rule, RMDs, maybe, maybe not, depending on the age, where the Roth is free and clear, 10-year rule, but no RMDs because it's Roth. I would have been wrong because the IRS came out and said, listen, if there's something other in that 401k account besides Roth, which is actually very common because employer contributions are usually made with pre-tax dollars. So I could have Roth deferrals, but employer match, employer profit sharing, that's usually pre-tax. They said if anything is in that 401k account besides just Roth dollars, then the non-spouse beneficiary is subject to the 10-year rule, and they're required to take annual RMDs from the full balance, including the Roth source, which is kind of a bummer for non-spouse beneficiaries, which is then going to encourage people that have had balances hanging out in these 401ks that have Roth to say it probably makes sense to potentially roll the Roth portion at least out of that 401k to an IRA, so when the beneficiaries inherit it, they don't have to take RMDs, versus if it stays in the 401k and there's pre-tax dollars, then they got to take RMDs on the full amount. All of this confusion around the RMD rules for the 10-year ruled non-spouse beneficiary has created a pitfall for stretch rule non-spouse beneficiaries. So those beneficiaries that aren't subject to the 10-year rule, that are only required to take RMDs each year, some people got confused that because the 10-year rule people were taking RMDs for 2021, 22, 23, 24, some stretch people thought, oh, it's all non-spouse inherited IRAs don't have to take RMDs until the IRS rules on this thing. That's actually not true. The only relief that the stretch rule beneficiaries have had was in 2020. 2020 was a year during COVID that they said, hey, if there was an RMD requirement, you don't have to take it. But then starting in 2021, those stretch rule beneficiaries were supposed to restart their annual distributions from their account. Let's talk about tax strategy. So because now these non-spouse beneficiaries have this condensed 10-year window to take these distributions, there's two general strategies, whether you have a Roth IRA or whether you have a traditional IRA. So a lot of our clients that get Roth inherited IRAs that don't have to take RMDs from the account, because Roth by nature, all the accumulation is essentially tax-free to the beneficiary. A lot of times when you inherit a Roth IRA, you essentially are giving another 10 years to get as much accumulation as you can. And then in year 10, you can take out all that accumulation completely tax-free. It's super powerful. Versus if you inherit a traditional IRA and all that money is going to be taxable to you at some point, you really have to map out a tax plan for the next 10 years. If you're going to be retiring soon, you might not really want to take any distributions until you retire when you're in the lower bracket, or if you have kids going to college soon. You showing more income from these distributions from these retirement accounts might not be a good thing because it could reduce your financial aid, or it could bump you up into higher tax brackets if all of a sudden you wait till year 10 and have to take the whole balance out. So you have to be very strategic as to how you have your tax plan for this 10-year period. I hope this video was helpful. If you have any questions on non-spouse beneficiary IRAs, please feel free to reach out to me at greenbushfinancial.com. Thank you.